In this lesson, we're going to look at the playbook and the different plays that we have and can use to create our strategies and our automated strategies in the backtester, as well as the discretionary strategies and market interpretations. So if we jump right into this and you open up the playbook, you can look at the different plays that we have. And what is a play? So a play is an opportunity for a trade. In the same way that we have opportunities for trades in what we call the strategies, the difference between the play and the strategy is that the play actually has many different ways in which it can unfold. So we can use an opening drive strategy with different parameters and different types of opportunities that are available. So you can have a long, you can have a short, you can have an opening drive within certain higher time frame market conditions, within different volatility settings, and also from a discretionary standpoint. You can use the plays in various different ways, more as principles that should be respected for your risk management and take profit and so on. Of course, our definition of plays could be more vague and larger than what other people might use. But when we're talking about strategies, that's when we get very technical and very precise with the exact entry, criteria, and settings that we have in our auto backtester. So if we overlook at the first play here, we have the opening drive. And what are we looking at in terms of entry criteria? So we're looking at a nearby overnight high or low. So we're looking at some kind of range or some kind of support and resistance and some kind of level that we're looking to break on the open. And that's usually the type of opening drive that we like to have and use. But there's many different ways of defining your opening drive. So this is our guidelines on how you use an opening drive. So we usually look for a level of resistance where, okay, we're looking to crack through this area. And then an additional factor could be a gap. So if we have a gap overnight and we see the opportunity for a quick move down to this target area for the gap to fill, then we could be looking at potential opening drive strategy. The volume is another indicator. So depending on the context, what type of volume and what type of participation are we looking at in the market? Aggressive or more passive. So it really depends on the conditions. But you could, high volume is what we'd look for on the opening drive. Front run by NQ or ES. So that's an example. Of course, if you're using different instruments to trade, then you can look at different correlations. But see, is there one instrument that has already developed the move? Has the move commenced with another indicator? And if it has, then perhaps we could expect the highly correlated instrument that we're trading to do the same thing. So that's another element that could play into the opening drive strategy. Now, of course, that doesn't define all of the opening drives. So you could have other opening drives where you just don't have the same criteria. It doesn't fit into your criteria, and this is not a strategy for you to execute. But the play is still there. It's just it's not for you to execute, and that's the main difference between traders who understand their playbooks, who have studied them, who know the statistics behind it, the trades they're going to take, and the odds, and the ones that take trades out of fear and guessing. And then exit conditions. Of course, we get into a trade, we want to manage it well, but we also know how to know when to exit. So very simple. For an order flow trader, if the trade slows down, not all order flow traders do it this way. Some really wait for the target, and if they get stopped out, they get stopped out. Personally, I like to pay attention to the speed of the tape and see, okay, how is order flow doing? Are we looking at a slowdown? Or do we have some absorption? Is this a slowdown or absorption that we would expect? And this really is a way that I like to manage my trades and entries and exit. So in combination with my target. So that is that's it for the opening drive. If we scroll down a bit lower to the overnight gap, obviously it's the gap that was created overnight. So at the end of yesterday's or the previous day's RTH session, there was a closure. And that point could be identified by the settlement afterwards. And then if we have a volatile overnight session, and then we open up now at a level higher or lower, then we can find an overnight gap, and that's how it's defined. right? So you can see, okay, yesterday we closed here. Now we're opening much higher. That's the opportunity for a gap to fill, or to attempt to fill at least. So entry criteria. We're looking at a gap to be filled since the last RTH close and the morning open. So in some circumstances, you could be looking at an overnight gap that is counter trend. So if we have a main trend going upwards, we could be looking at a counter trend overnight gap, but we could also be looking at an overnight gap that is following the trend. So there's different ways to look at the overnight gap. You can say, okay, in this market where we're uptrending, are we seeing a pattern and opportunities for overnight gaps that go against the main trend? So that would mean that you'd fill the gap between yesterday's close and the open, and then pursue and continue with the trend. We like to make the difference between the counter trend gap and the gap that follows the trend. So if we're looking at an uptrend generally, but we're noticing that in this uptrend in the morning, we tend to push down lower and then continue with it upwards. And we notice that this often occurs with an overnight gap. So there's a close and then overnight we would move up and open up higher. Then we would look for an opportunity to try to close that gap. So just move down a bit lower and then close that gap and then continue on upwards. So that may be an opportunity for short. So it's a mean trade in an upward and uptrend environment. And then of course there's the trend following gap. So if we are if we're in an uptrend and we're doing the exact opposite of what I described. So a gap is presented where you would want a long. So overnight we had moved down. So we closed higher the previous day. Overnight we've moved down. We open up lower. We know that this is an uptrend. Well, you can get long and attempt to fill the gap and perhaps surpass it and continue on for much higher levels and targets. So those are the two overnight gap opportunities. And of course, you can manage your targets and the order flow to see when you would exit. Initial balance. So there's different ways of using the initial balance. So one play could be for a breakout after the initial balance has occurred. So as soon as the initial balance is defined, so we're looking at from 9:30 to 10:30. As soon as that period of time is has occurred, we would look at a breakout of that box, and that's how we display it on the chart. And I've seen other traders display it in the same way. We have a box on the chart or some horizontal levels, and as soon as we would break out of that horizontal level, that's where we would get an opportunity to get long or to get short, and say, okay, well, we're going to close the trade, at a specified fib extension level, or at a specified time, at the end of the day or at the end of the session, or even at a support and resistance level. So for you to choose what your target is, but that's an opportunity. And then another opportunity is to have a retest. So you'd wait for the initial balance to form, a breakout of the initial balance. Then you'll retest inside the initial balance, and you could choose any point, within your initial balance. It could be the midpoint, or it could be, again, a fib retracement level, so a 618 fib retracement level, or any level you choose, support and resistance. Pay attention to the order flow and then see, okay, this is an entry opportunity. So on that retest, then you could continue on further. A nuance, of course, is that with the second option, you're more likely to enter later in the day, of course, for the retest. It can happen sooner, but in some occasions, it may occur just a bit later in the day. So that's a different type of trade, but very interesting. And of course, another variation would be for a mean opportunity in the initial balance trade. So that would mean, we would break out of the initial balance, and as we're going for that retest, well, we would get, if we were long, we would get short and then aim for a retest inside the initial balance. And that's another initial balance variant. And for the exit criteria, similarly, support and resistance, fib extension levels or retracement levels. Move down to the divergence or SMT plays. Now you could be looking at different types of plays. So the SMT divergence is a very popular and common ICT, smart money technique is what it stands for. And this, as we don't really trade ICT concepts much, but we're open to all concepts and trade principles and trade opportunities that work and function. So if we see a trend in the market and we notice that some SMTs are holding, which is very simple. The SMTs are simply a divergence and a difference in character between the highs and lows of two instruments. So if we look at it ES and we see a higher high on ES, but then we're looking at NQ and we're seeing a lower high on NQ, then we could be looking at an SMT there. And there's different ways to set your criteria for the SMT. It could be, okay, well, I could confirm that SMT is actually an SMT if after X number of bar closes, so it could be on like a really small time frame. If you could use it on tick charts, you could use it on very short time frames, but you can also use it on the higher time frames as well, if you want, and test them out and see, does this strategy work? Does the SMT hold? And often, the SMT, what you're looking for is when you see that divergence between the higher high and lower high in the other instrument, but then you'll see a move in the opposite direction. So it's similar to like a double top, but it's just a bit more precision. So you're looking at both highs, you see the divergence there, and then you're looking for an opportunity to go against that move. So if you're seeing an SMT at the top, then you're looking for a move down lower, and if you're identifying the SMT at the bottom, you're looking for a move up higher. I find them to occur quite frequently for ES and NQ on the lower time frames. If you pay attention to slightly higher time frames, like 30-minute, they can occur as well, just in a different way. So keep in mind. So these are the SMT divergence plays. Scalps could be simple order flow patterns that you've identified. Harder to backtest with stats. Certainly not a strategy that you're going to backtest in trading view with the auto backtester. But there's different way to backtest the strategy and see if it's a viable strategy for you. More manual, more forward testing, but nevertheless, scalping is very interesting. There's numerous ways for you to scalp. So, depending on what you're looking for, are you looking at market structure mainly on lower time frames, in accordance with maybe some higher time frame conditions? Are you looking at order flow to make your decisions? The DOM, the footprint. What's your criteria for you to scalp? And that's it can be very broad, it can be very different depending on your style of trading. For myself personally, I like to have market structure suggesting price that may immediately touch a specific area. So we have a bit of market structure there, and that's very discretionary. When I speak of market structure, I'm looking for a small range or small pattern to develop, or maybe an SMT to occur, and then for my price point to be touched. And that's where I place my exit, so my limit order. Without a limit order, I could just exit on market as well, depending on how I want to exit. Order flow. So order flow would suggest the price may immediately touch a specific area. So order flow the behavior, the movement, the speed of the tape, the delta and the volume, of course, can suggest that a scalp may be good to take. Exits, very similar to the other strategies in plays. Support and resistance, order flow, breakout. So a breakout, we have higher time frame breakouts, lower time frame breakouts. These can occur when their consolidation, has ended, and we're looking to reach new levels. We could be looking at a breakout, and that play, of course, there's many different ways that we can play the breakout. There's a classic way with the initial breakout of the range. You're looking for, and that could be combined with an opening drive, right? So you can combine many aspects of these plays, and they shouldn't be used only on their own. You can have an overnight gap, but that also coincides with a breakout and also coincides with an opening drive, and then you'll have some elements where you may be able to scalp a certain part of it, or if scalping may be a way to manage your risk, so you can start out with scalping out the move and then trail your stop as you continue. There's just so many different ways that you can play the breakout, right? In all of the plays that we're presenting, but a very classic way is there's the initial breakout and then there's a retest. So that's a way for you to play the breakout. Now, for the instrument divergences, it's very important to look at the two instruments or the few instruments that you like to trade, and look at how strong is the correlation. What are the patterns that we're seeing? And when one instrument breaks out or acts in a certain way, and the other see, you can look at the order flow and it seems that it's going to get closer and it seems like it wants to follow, but it hasn't yet done it, then you can combine other criteria also to say, okay, well, this is a specific play that we could be looking at. This is a pattern that we've seen in the past few days and weeks, and we expect it to happen at this moment. So if we're looking at ES and NQ and we see, NQ has fallen down and just keeps going, and then ES is at a point where there's a level of resistance, it may act in the same way. So there's a divergence in price. One has drastically moved and the other is set to do the same thing. But you have to be careful with this play and have some good criterias and good analysis of the market and the trends. In some cases, this play could really go against you. And you could be looking at one instrument that has some kind of large move that occurs. It reaches a level of resistance and then reverses, while the instrument that you're looking to trade and you were expecting perhaps follow, so if you saw NQ breakout, you're thinking perhaps ES would do the same thing. ES doesn't break out, stays within the range. NQ breaks out, but then continues and reaches a level of resistance, then turns around and starts moving in the opposite direction. Then the ES would follow in the opposite direction. So that's another play. But then that's also another way that you can get trapped in these initial versions. So there's different versions of this play. So there's the first one where you're expecting both to follow, and then the second one where you're expecting a reversal after the initial breakout of the single instrument. That was leading initially. Delta flip is the instance where there's many different situations in which this could occur. You're in a range, and I've seen this many times after the open. So you can have a big move in the open, then a range forms, maybe around 10 o'clock. A range forms, and you notice a lot of short sellers are in the market. We've moved up a lot. We're looking for some shorts, but they just can't really get the price to fall down lower. And at some point, the market really slows down. And I've been short in those situations. And the market doesn't really fall down much lower. And the shorts get exhausted. And then all of a sudden, we look at the delta at the bottom of the candle. So let's say you're looking at a 5-minute or even at your tick chart. And you look at the bottom, if you have your statistics displayed, and you can see the delta. And it flips from negative to positive. That's the delta flip there. At the same time, you may get a rush of aggressive or even passive buyers pushing the price up. And all of a sudden you get a surge and a push up and a liquidation of the shorts. From there, the price may fall back down and then you could have the short play. Or you could have a bit more than the scalp and then get like a full play and a continuation upwards from there. So that's one example of a delta flip, but there's so many different instances in which that could occur. So very interesting play. Exit criteria, same as above and the rest. Hedge losing trades. You want to be careful with that one. So if you're trading futures, you want to be careful with your hedging. Obviously, you cannot hedge, and well, obviously it's not so obvious. You may not know this already, and it's totally fine. Now with the CME, you can't be long and short in the same position if you're trading the futures. So if you're long in ES, you can't also be short. It's not how that works. I know this is possible with CFDs, not possible with futures. And the way to do that with futures would be, you're long ES, but then short MES. You shouldn't be doing that. A way you could hedge is be long, ES and then short NQ. You can do that. Two different instruments. It's not a method I like to adopt so much, but I've used it in the past. I've used it with success and with some failures as well. So something to keep in mind. Maybe your style of trading. Many institutions use a hedging method to their trades, and it allows them to manage a position that it's a losing, but initially turn it around and turn it into a positive situation for them. Just a different approach. Inside day extremities. Inside day is if we have a previous very volatile session. So if our previous day is very volatile, and then we open the next day within an extremity of that day, or even within the range, it could be in the middle of the range, we open the day. Then we're looking for an opposite trade at the extremity. So if the market moves up, we would look to get short at the extremity of the previous day. And that could be an extremity of the day prior to the previous day. So it could be from 2 days ago, it could be from yesterday, depends on your play exactly and how the market is set and the opportunities that are presented. And different times you can have different types of inside day extremities extremity plays. But in this type of day, typically you're going to want to avoid trading in the middle of the range. And then of course you can have certain situations where you do have some smaller ranges, within the inside day that have formed. So you can use that as well. But that's the principle of the inside day, is really to wait and see, okay, can we trade at the bottom or at the top from previous days ranges. So that's the complete overview of the strategies that are provided here. I'd like to hear your feedback and hear what strategies work for you. How have you optimized them? Do you have any strategies or plays that you want to add to the playbook? And sometimes we'll interchange strategies and plays as a play can become a very specific strategy, right? But if we want to be correct using the terms in our membership, the plays are the broader plays and somewhat or a bit vaguer principles, and the strategies are the ones that with a lot more precision, with ideally some statistics to back them up, and these are the ones that are optimized as well. So we're looking to optimize the strategies, and that's the complete overview for the playbook. And we'll see you in the next one.